Very good morning. It is Monday the 5th of June. Hope everyone is well. Just taking a look at the charts this morning before we get underway in the briefing. A reminder, it is Whit Monday, which is taking place across much of mainland Europe, which means that some of the markets are affected this morning. German, Swiss, Austrian stock markets are closed for Whit Monday. Bunds are still trading as per normal and French equities are still open. So just worth keeping in mind. In the middle of my charts on the centre left, I have changed those to, I've changed that to the Euro stocks, but obviously even that will be impacted given some of those respective markets are closed. In particular, no DAX trade today. But quite a few things coming out at the weekend. But first of all, I thought I'd start with non-farm payrolls, a quick recap, and a look how the markets reacted, because just looking at the S&P here, at the point of when non-farm payrolls originally came out, was of course 130. That's highlighted by that big downward candlestick that you can see there, and that selling pressure that proceeded shortly around the open on Wall Street. I remember tweeting at the time when non-farm payrolls came out, it was a pretty all-round bad report, and I said all-time highs at the close of the session. Lo and behold, it came surging back and all the way up until the close, printed just before the close, all-time highs. It's an incredible market and reality that we live in when it comes to US equities. But a quick recap, of course, the headline NFP, 138,000 for May, which compared to the consensus estimate of 182,000, a further net 66,000 of downward revisions to the prior 2 months. That means the last 3 months, the average increase in non-farms has fallen to 121,000, down from as high as 201,000 if you're looking back in February. With that last statistic though, I'd take it in a bit of context, because of course when you look back to the March reading, this was very much impeded by the adverse weather conditions at the time. Storm Stella very much heavily affecting northeast coast of America, and so therefore the ability for people to get jobs, and as such I'd kind of extrapolate that number out of the equation, so to speak. But nonetheless, certainly we have weakened here from where we were at the beginning of the year, when we were up kind of punching well above 200k. So why did the equity market recover like it did? Well, we're kind of moving back to that era, it almost feels like, that we had been in for such a long period of time, where if the bad news is bad enough, it is good news when it comes to US equities. And it's kind of how it played out on Friday. You had that initial kind of negative response, which made sense. Obviously Treasury yields fell sharply, gold spiking on the upside, equities initially moving lower. Now the reaction has been sustained. The dollar weakened substantially on Friday and it remains weaker. Yields remain suppressed. And the only other thing that we saw though, that final couple hours on Wall Street, equities then turned. This is because people start looking forward to what does this mean for the Fed. A couple of the headlines picking up in the press this morning: fresh doubt raised over Fed rate rise. Now, they're not talking specifically about the June rate rise. Don't forget, we are now into the blackout period for the Fed interest rate decision we'll get coming up later in the month. So this is when they go into the traditional period where they're not allowed to speak in the run-up to the event. But it's all about the subsequent hikes thereafter June. Now at the moment, Bloomberg's calculator is pricing in a June rate hike at about 90%. Non-farm payrolls release actually did little to really change the June perspective, but it certainly did move the needle a little bit about when's the next and final telegraphed hike that the Fed said they were going to do for this year, the third one. September is looked a little bit less likely. And so it's the more shallow trajectory that's seemingly getting priced in. And this also comes amid, of course, this key part here, subdued inflation and signs of weaker economic growth. Remember, Q1 has been particularly weak, weaker than expected, despite the pickup that's expected in Q2. Q1 was weak in the US, and inflation, if anything, has remained fairly benign. It hasn't started to continue a sharp move on the upside. If anything, it's still fairly subdued. So after this hike, you still got to say that we could be in for a similar situation to what we had on March 15th, where the hike really means nothing because the market's fully expecting it, and we actually might get a more dovish response to the communication thereafter. But certainly this has kept the equity market up close to these all-time highs. That now resides in the S&P up at around just shy of 2440. And as you can see, bottom right, Treasuries finding a bit of support overnight, a fairly quiet trade at pivot 126.16.5, and gold has held on to the gains really that were seen on the release of the data on Friday, where we managed to break that previous high on the week. We've continued to add to some of that, up around $4 this morning. Certainly looking at gold, upside, obviously that high point that we originally had on the 17th of April comes in at 12.95. You know, in reality, we're only $15 short of that, and then the psychological $1,300 handle again, which would be a big level to keep an eye on. Any move beyond there, you start looking at where we were on the peak of really last summer, and obviously this is when we had the Brexit situation, when we were up close, getting towards circa 1400. So that was kind of the story on Friday. Looking what's happened over the weekend, obviously I don't want to dwell on the point too much, but I'm sure you're all fully aware of the headlines. Another terror attack in the UK, a third time in 3 months, I believe now. And so Theresa May vowing to ramp up the battle with extremism after the London Bridge attack. Now, that attack itself hasn't had any real implication for the financial markets this morning, but certainly going forward, this could be something that may influence potentially some of the election sentiment, you could say. When this happened, the Manchester attack, we did see a bit of a re-widening toward the Conservatives at that point. Whether or not this will take place again is yet to be seen, but looking at the polls which occurred over the weekend, so this is pre the attack, the YouGov Times poll conducted over the 1st and 2nd of June had the Tories holding a 4% lead over Labour. But quite interestingly, Survation Mail on Sunday poll conducted on the 3rd of June showed just a 1% lead for the Tories at 40 to 39%. That then is the smallest lead for the Conservatives in any opinion poll seen thus far. So as you can see from the graphic, on the average poll of polls, I think this still needs to update to take into account the two I've just spoken of. If anything, that's going to pull these two lines, the blue and the red, even closer towards each other. But again, this isn't really having too much of an influence on the pound this morning, and I think this is because, as we discussed last week, most people are still sitting on the side that the Conservatives will capture a majority. The question mark is as to what size. Obviously the outlook as it was about 6 weeks ago, also about a runaway, huge-sized Tory majority, is probably not going to happen. So now it's just a case of, is the majority kind of 50 plus, 40 to 50, 30 to 40, scaling it all the way down to the most negative from a market reaction point of view. Certainly sterling depreciation would be if there's a hung parliament. I'm going to do a full actual election preview about trading the event. I'm going to do that later on this afternoon, probably towards the end of the day, so we've got, we're ahead of the game in what to expect in that regard. So more on that to come later. One of the other things to keep in mind from a longer term point of view, so this is less kind of intraday relevant, but just quite an interesting headline post-election, is that sovereign wealth funds and central banks may look to cut their UK assets in 2017 after sentiment toward the country slumped since Britain voted to leave the EU. So about 41% of institutions, who together oversee $12 trillion in assets, said they expect to introduce new underweight positions in the UK. Now, it's this kind of herd mentality, if you like, of large-scale investment into the UK, which ultimately does mean that post this event, regardless of outcome, the longer-term outlook is certainly a negative one for the pound on balance. Most people anticipating the fact that with inflation going to tick up, household income is going to get further pressured in that type of environment. It's going to mean that economic growth will slow. Foreign investment into the UK due to the uncertainty surrounding Brexit would probably reduce, as per the comment I just said, with a number of wealth funds and central banks looking to introduce underweight positions in the UK. So the ultimate outlook still looks particularly bearish, I'd say, in toward the rest of the year post this election event. Obviously that could be almost hyper-accelerated if there were a hung parliament situation, which would initially cause, according to some bank estimates, an immediate kind of 3 to 5% depreciation of the pound. Just having a look what that would look like from a current pricing point of view. So we're trading around 128.75 this morning. Let me just get my marker on my chart. So we'd be looking roughly 3, 4, let's say a 5% fall would take us back down to kind of sub 123 handle in that situation. That's certainly, I think, what Barclays are going for, Barcap. Any move beyond that, if we were, I guess, to get that low, ultimately we would no doubt test that 120 at the bottom of this longer term range that's been in play post the actual EU referendum itself. That would be a really big level on the downside in that kind of setup. Okay, one of the other big headlines though from the morning, actually, that's drawn some attention is this one. And this is looking at 4 Arab nations have cut ties with Qatar. And this is particularly interesting for, I guess, the political harmony within the Middle East. So Saudi Arabia and 3 other Arab nations have severed diplomatic and transport ties with the Gulf state of Qatar, claiming Doha's regional policies fuel extremism and terrorism. So it's Egypt, the UAE, and Bahrain. They're talking about their Qatar's relationship with Iran in particular is where the contentious issue lies. Now this has seen Qatar's local stock market open down 5.5% this morning, and it has contributed, albeit it hasn't really been a sustained or a sizable move, but it certainly raised a few eyebrows when the early European traders started coming into the market and the news started to break. And it's lifted crude oil I'm looking at here. We managed to just get above the highs that were seen the end of last week in the evening. And so we've risen from early Asia Pac session, kind of 47.75. We did get up to highs just above what would be the R1 today, printing at a high of 48.42. So some of that's been paired. It will be interesting to see how the US reacts to this when they come in. I had a question this morning, my kind of thoughts on this as a topic, and how much will it move the market. Well, I guess one thing, I see this as being maybe a short-term supporting factor for prices. It wouldn't surprise me if when the US come in, you might get another round of buying into the move. However, will this be sustained? I highly doubt, because the whole situation of US output still on the increase. That was the same with the rig count at the end of last week. This kind of inability of OPEC, their kind of diminishing power, if you like, to influence the price of oil in comparison to its competitors in North America. I still feel more bearish in that regard, but this could act as a short-term kind of reprieve for prices, I guess. Certainly when the US come in, I'd be interested to see how the market reacts to that. But longer term, or medium to long term, I still don't think this really changes the situation unless it sours further. Certainly from a Qatar's point of view, I think they rely, I heard Bloomberg talking about it this morning, they rely heavily on a lot of their food supply coming out of Saudi Arabia. And if Saudi were to cut off that, then obviously that would cause a surge, a huge spike in inflation in Qatar, which would be a catastrophe for their economy. So I'm sure you're going to hear a little bit more airplay on this issue going forward. Okay, quickly just to round off some of the other key headlines from the weekend. This is overnight news. Obviously, last week we saw a bit of a divergence between the Caixin and the official government manufacturing PMI coming out of China. The private measure being the weakest it's been, contractionary territory the first time in 11 months. Creates a little bit of nervousness, but nothing really that the market got too, or impacted the market too much at this point. But somewhat settling those nerves has been the independent gauge of China's service sector overnight, where growth rebounded last month from a near 12-month low. Narrowed the spread with its official counterpart, pointing to greater divergence with the country's manufacturing sector. So the service sector seemingly in better health than what we saw out of manufacturing, as you can see defined really by this cluster of the two lines pointing higher here, the service numbers comparative to manufacturing of what we had at the end of last week. So China still not really a focal point for market movement at this point. Certainly the US is still the dominant theme, but worth just tracking these things in the background. Elsewhere, obviously a very big week for the markets. This week, let me just bring into shot the calendar. Now, all of these service PMIs that you're seeing this morning, these are all final numbers, I believe, so I'm not expecting them to be too impactful, but the service number out of the UK, as ever, will need to be watched. We'll have a look at the background on that in a second. Some other interesting data points coming out from the US. Factory orders and ISM on manufacturing this afternoon. You've got the RBA rate decision on Tuesday. All inventory numbers as per usual, Tuesday and Wednesday. German factory orders on Wednesday. But it's really Thursday that's the big day. Obviously, polling booths open 7 AM to 10 PM on Thursday for the UK election. So the actual election date is still to go ahead as planned, despite the terrorist attack at the weekend. Polling booths will shut at 10 PM, of which there will be an immediate exit poll released, I've been told. The other key things here in particular is the ECB rate decision. Then you've also got the former director of the FBI, James Comey, is testifying to the Senate. And obviously the implications that could have in any credible details coming out in relation to Russia, and obviously Donald Trump could be pivotal for Trump's future and its underlying ability, or his underlying ability, to implement policies going forward. So that's going to be interesting. Thursday's the big day. That's your newly deemed Super Thursday, if you like. And then Friday, you've got UK trade balance, IP, manufacturing, construction orders. So quite a lot of things coming out, but Friday's going to be probably, I would imagine, dominated by post-election analysis and reaction. Obviously, if we do get a hung parliament, then you might as well just take Friday, all this data, and just screw it up, put it in the bin, and just start shorting sterling in terms of the short-term knee-jerk reaction. But again, we'll talk about that more later. From an ECB point of view, though, it is a big week because everyone's been looking at June in the timeline as to the ECB giving the subtle nods towards an improving economic situation in Europe, to therefore define the start of the process of coming out of such an accommodative monetary policy stance. What we're expecting this week is the ECB to say risks to growth are now balanced. Remember, that phrase has been somewhat moved from diminished, downside risks have diminished and so on. Now it's going to move up and upgrade. The next level would be to balanced. ECB change to its rate guidance, though, according to most economists, will come at the July 20th meeting. So an actual change in communication is not going to happen explicitly this time round. And a couple of things that these articles this morning are looking at is a lot of it's talking about inflation. Again, much like a similar situation to the US. Yes, it's been picking up, but no, it hasn't been picking up as sharply as some might have feared. So lessening the need really for the ECB to be so proactive in tightening policy at this particular point in time. Going forward though, ECB to announce QE change at the SEP 7th meeting is kind of the broader market expectation. Likely extending into 2018, flagging reduction in monthly purchases. So we're not really looking until getting up to Q1 2018, the ECB to start gradually phasing out QE program. And then remember, the ECB's latest communication has been we're hinting towards they're not going to change the sequencing of policy, i.e. a lot of talk a few months ago was about the ability that they might have to not follow the Fed model, and they might raise the deposit rate while keeping QE going, but some of the latest language would indicate that that's probably not going to be the case, and that they'll look to tighten and phase out QE before then looking to raise interest rates. So it's going to be interesting this week. I did send you out a preview of that in your research, should be in your inbox. Then one other article, this is kind of flying under the radar at the moment. It's nothing that's going to move the market here and now today, but it's certainly something which people might start to talk about more and more over time. And this is Trump is said to pick two nominees for two positions, or said to pick nominees for two positions on the Fed board. Now, if you remember, there are some vacant positions on the board of governors at the Fed at the moment. And this New York Times article is talking about expected nominees including Randall Qualez, a Treasury Department official under the Bush administration, and Marvin Goodfriend, a former Fed official, is now professor of economics. Now, it's quite interesting because both these guys tend to sit on the slightly more hawkish side, which is kind of what we thought from originally what Trump was indicating, that he was unhappy with the kind of loose stance of the Fed. Mr. Qualez would also become a leading figure in the administration's efforts to roll back financial regulation. He would be nominated to serve as the Fed's vice chairman for supervision, with responsibility for overseeing the Fed's regulatory responsibilities. And he's been a person who shares a similar view on that issue to Donald Trump. So you can see how Trump indirectly is looking to influence almost central bankers, even though we know that the government and the central bank should be acting independently. So this could be something to just monitor over the months ahead. Otherwise, let's just drill down into the session ahead specifically for today. Again, you've had the final service PMIs, so they've not really had much of an overall market impact this morning. And don't forget, Germany, in terms of the equity market, is closed. A lot of European participants might be out the market to reserve this religious holiday in mainland Europe today. Certainly the Swiss and Austrian markets are closed as well. And so you might get a fairly quiet morning, certainly from a volume perspective, looking for the US until things really start to pick up potentially. For the UK though, 9:30, you do have the service PMI number. Of course, this is the most important for the UK, particularly given it has such a big ramification for the makeup of GDP in the country. The data itself though, the previous reading at 55.8 was above market expectations by quite a clear margin. It was the highest reading since December. So it's been pretty strong of late. What's going to be interesting is, can these UK data points continue to remain robust once the consumer comes under further pressure as inflation continues to rise. So that number I'd definitely be watching if you're trading cable later on. And then going into the afternoon, ISM non-manufacturing PMI, I'd keep an eye on that. Then you've got factory orders as well this afternoon, and the revisions for durable goods. So quite a few things coming out. Nothing too major, because I don't really foresee any of this US data really influencing too much what the Fed are going to do. Certainly the Fed are on track to hike. The question is, if we get sharp deterioration in data points from a US perspective, then certainly this might alter their discussions at their upcoming meeting. So that's how the market might react. In that situation, I'd be expecting T-notes and equities to remain bid, as the market needs to reprice itself for a kind of dovish hike situation. Okay, so it's your brief for this morning. Going to leave it at that. So overall, Market movement this morning, fairly quiet. A lot of Europe out of the market. The US, I would say, is probably going to offer better trading conditions as the volume picks up and associated market movement. But generally speaking, I guess still a bit of digestion of NFP situation on Friday. So equities just still close in the US perspective to all-time highs. Gold elevated with US yields still depressed, with the 10-year still supported by pivot. A little bit of downside pressure in European equities. I'm looking at the Euro stocks here. That's probably more a byproduct again of pulling off very high levels that we traded towards all-time highs last week in the likes of the German stock index as well. So that's your wrap. Catch you in the chat room. Any questions, please do let me know. And as I said earlier, I'm going to do a UK election preview later on this afternoon. Don't worry if you miss it. It will be recorded and I'll be posting it in the chat room in the coming days as well. All right, guys. Have a good day and a good week. Thank you.